Hello students, in today's video I am going to discuss income statement or profit or loss account items. I am going to discuss different expenses and revenues, income, etc. After that I am going to discuss double entries for expenses and income. So let's start. First of all, I am going to discuss expenses. Purchases. Whenever business buys goods for resale and also, for example, raw material purchases. They are all purchases. I repeat, goods for resale or raw material purchases. Then we have cost of sales. Cost of sales is also known as cost of goods sold. All costs incurred to purchase or manufacture goods is cost of sales. Okay, then we have rent expense. So you can see all these expenses are like day-to-day running expenses of business. So if we are doing business in a shop, we have taken that shop on rent, whatever rent we are paying, that's rent expense. Similar is insurance expense, marketing expense, admin expense. Admin expenses include all costs incurred in the office. For example, admin office, HR office, or accounting office. Next, we have selling and distribution expenses. So, I think I should further classify distribution expenses. Distribution expenses include all expenses relating to warehouse or delivery vehicles. And then we have selling expenses relate to all costs incurred in sales outlet. For example, salaries of sales staff, rent of sales outlet, insurance, utilities of sales outlet. All those expenses will go under selling expenses. Next we have interest expense. Very simple. Most businesses borrow money to do business. So whatever money business borrows, business has to pay interest expense on that. Interest expense or finance cost is the same thing. Then we have tax expense, salaries and wages, rates expense. So all these are examples of day-to-day running expenses of business. Next we have income or revenues. So these are different sources of income or revenue. So first of all, we have sales revenue. This is income generated from principal business activity. For example, our business is tuition services. Whatever cash income we generate by providing tuition services, that goes under sales revenue. Then we have rent income. If business has some spare capacity, business rents it out. Whatever rent income they will receive, that will go under rent income. Then we have dividend income. If company has spare cash and company has invested income, if company has spare cash, company has bought shares of another company and company receives dividend from its, if business has spare cash and business invest that cash in other company shares, if business buys shares of other companies. And if those companies pay dividend to the business, that will be dividend income. Interest income. We have some spare cash. We put that cash in some savings bank account. We receive interest income on that. That will be interest income. Simple. Commission income. If we act as a third party agent and we earn some commission from that business deal, that will be commission income. Okay, next we have rules of debits and credits for expenses. So for expenses, any increase in expense will go on debit side. I repeat, any increase in expense will go on debit side. Any decrease on expense will go on credit side. And next, we have rules of debits and credits for income or revenue. Income or revenue, whenever decreases, debit, whenever increases, credit. I repeat, income or revenue, whenever decrease, it will be debited. Income or revenue, whenever increase, credited. I would suggest you to draw these T accounts formats on paper. Next, we are going to do some practice of double entries, journal entries with income and expenses as well as statement of financial position accounts. So we have this question here. The very first requirement is to journalize these transactions. So year is 2007 and the first date is May 1st. Started business with £10,000 in the bank. So I can identify two accounts here. One is bank. Bank is an asset, increases, debit. Started in business with £10,000 in the bank. So that's capital that has been invested. So I will put here 10,000 and 10,000, just like we have learned in lesson number 2. Then we have May 2nd, purchased goods. Now this is something new. This entry relates to income statement or profit or loss account item. When business purchases goods for resale, we debit purchases. Goods are bought on credit, therefore accounts payable will be credit. Why am I crediting accounts payable? I'm crediting accounts payable because when business buys goods on credit, liability is increasing. When liability increases, we credit. What liability is increasing? Accounts payable is increasing. So amount 290, 290. Okay, next we have bought fixture and fittings. Fixture and fittings is an asset, increases, debit. Fixtures and fittings. Paying by check. Check means bank account. Bank is an asset, decreasing. Asset decreases, credit. So bank, credit. Whenever you see check, check means bank. Amount 1150, 1150. Third, actually it's a transaction on 5th. Sold goods. Sold goods means sales revenue. Sales revenue is income, increases. Income increases, credit. Sold goods for cash. It means business is receiving cash. Cash balance in the business is increasing. So cash is an asset, increasing, debit. 140, 140. Then we have number 6. Bought goods on credit. 325. Bought goods is again purchases. Purchases is an expense, increases, debit. and it's bought on credit, so it's accounts payable. Just like second transaction. Amount 325. Okay, next transaction on number 10. I will just move down these transactions. So, number 10, paid rent by cash. Rent is an expense. Expense increases debit. So, rent expense debit 200 and it is paid by cash. Cash is an asset, decreases credit. Next we have stationery. Bought stationery 45 pounds. Paying in cash. Stationery is an expense, increases debit. Cash is an asset, decreases credit. $45. Goods returned to D. James. Now this transaction on 18th is opposite to transaction on May 2nd. Very carefully please check. Transaction for goods return on May 18th is opposite to transaction on May 2nd. So very carefully, amount is 41. We will reverse this transaction. That means if purchases was previously debited, now it will be credited. If accounts payable was previously being credited, it will be debited now. What is the logic or reason behind this transaction? So we debit accounts payable 41 because we have returned goods. If we have returned goods, we are not going to pay for those goods to our supplier. When we are not going to pay for those goods to our supplier, then our liability is decreasing. Liability decreases debit. And on the other hand, it's purchases that has been returned. So I am crediting purchases, but we have a separate account for this one. It's called purchases return. Purchase return. It is also known as return outwards. Next transaction 21. So we have received rent of 25 pounds. First of all, received rent of 25 pounds by check. So that means in bank we are receiving money. Bank increases debit. Second account that I can identify here is rent. So rent is income. Income increases credit. Rent income credit. Next is 23rd. Sold goods on credit to G Cross for 845 pounds. Sold goods, sales revenue increasing, income increasing, credit, sales revenue. Amount 845. Okay, they sold goods on credit. They haven't received cash. or check. When they sold on credit, that means it's bank. So, sorry. When they have sold on credit, it means that it's accounts receivable. So, accounts receivable is increasing. Account receivable is an asset increases. Debit. Transaction on 24th. Bought a van. One account I can identify is van. So, van debit. Paying by check. Van debit. Bank credit. When is an asset increases debit. Bank is also an asset that has fallen in value. So that will be credit. Paid the month's wages by cash. So wages is an expense, increases credit debit. Wages is an expense, increases debit. Amount 360. It is paid by cash. Cash is an asset. Cash is an asset, decreasing credit. Last transaction is on 31st. Proprietor took cash for personal use, 80 pounds. So first of all, I can see cash. Cash is going out of business. Cash is an asset, decreasing credit, amount 80. And when owner is withdrawing money for personal use, it means money is going out of business. So we debit drawings. Drawing is opposite to capital. Capital whenever increases credit, capital whenever decreases we do drawings. Remember, drawings is the term that we use for sole trader or unincorporated business. We use term dividend for incorporated businesses or companies. So you can see drawing debit, cash, credit. So this question is done. 4.1 is done. I have question number 4.2 for yourself. I want you to give it an attempt by yourself. Try to solve this 4.2 by yourself. I will upload its solution in description box. In the next video, we will learn how to prepare and balance off T accounts for income statement or profit or loss accounts. Thanks for watching. If you like my video, please share, like and subscribe. Thank you.